Debt is the system of control of the central bankers. They created this in order to trap us. Each unit of currency is born out of debt, conjured like witchcraft in dark places unseen by the majority. In doing so, they gave themselves unlimited wealth, literally owning the printing presses. Funding nations and their conflicts, central bankers are responsible for most of the world's problems. You came here for the truth, so let me unveil that for you. Today we're going to look at debt, and more debt. That is the topic for today, and I want to begin by taking a look at this report out of the IIF, that's the Institute of International Finance. I've shown you some of these reports before. This is the Global Debt Monitor, and global debt rose by over $8 trillion in the first quarter of 2018 to over $247 trillion. That is 318% of GDP. Now, this is skewed both ways because the GDP numbers are overinflated. I've covered that before, as well as the amount of debt that these countries have themselves in does not include the unfunded liabilities, off balance sheet, off the books type of numbers. So it is much worse than what they are admitting here. And just looking at it the way they present it, it's extreme. It's impossible to ever pay back. The world is in so much debt, and this is the system of control of the central bankers. This wasn't an accident. This is intentional. We are put in this position on purpose to then hold nations hostage. I don't think the average person, even that which is paying attention, doesn't realize that central banks are not at the government level. These are all controlled by the same group of people, and they sit above this government. They make the decisions not based on what they are told to do by their Parliament and Congress. We know that's not the case. Even Greenspan himself said, when he was the chair, he said, there's no authority that can overrule our actions. And he's completely right. Now, this is an article out of Reuters talking about that IIF report. All right. So the report released by the IIF, a global bank lobbying group, said the ratio of debt to gross domestic product of these nations, which includes the group of 7 industrialized nations and the majority of emerging markets, increased to 318%. That's the first quarterly increase in the debt to GDP ratio since the third quarter of 2016. Now, yes, the debt has been increasing, but the ratio has been the only change here. With global growth losing some momentum and becoming more divergent and the US rates rising steadily, worries about credit risk are returning to the fore, including in many mature economies. I think that we do have a problem. It's talking about the interest rates here, which I'll mention more in a moment, talking about the debt levels for households, non-financial, corporate, general, government sectors rising, and so on. I think that this is an issue that needs to be addressed, and the reason why the debt exists is never ever understood by the vast majority of people, even those in the industry itself. It is quite sad that people don't know how money is born out of debt. That's the way it is today. It's not real money anymore. This right here is the amount of credit card debt that we are experiencing here. In the US, of course. Total revolving credit owned and, my favorite, securitized. During the financial crisis, we saw the deleveraging occurring. Some people had to start paying this off, whether they liked it or not. We saw throughout this time period, there was a little recalculation, if I remember correctly. So this is not a drop. It's simply some sort of recalculation that they were doing. You could see how it was stagnating in this period, but no, just a little blip. And we are now headed onto more and more credit card debt. People are heavily indebted, and this is all dependent on the amount of interest that they are currently paying. Total consumer credit change, you can see that that has risen right now, just on the right-hand side here. There was this understanding that, oh, maybe this is it. Maybe they're going to start deleveraging, but absolutely not the case right here. revolving consumer credit and monthly change. You could see that just now. In fact, this has really increased. And then the Fed funds rate, something that I show often, but it seems like the majority doesn't understand it, but I know that if you are a regular viewer, you definitely do, and you're aware of this. This is the Fed funds rate going back. I pulled it back to the late 80s. And these shaded areas, of course, are recessions, okay? So understand that. And every time the interest rates get to a particular level, we have a crisis, okay? Right here, 3 previous instances, okay? The Federal Reserve existed during this time, the Federal Reserve existed during this time, and the Federal Reserve existed during this time. Yet they did not fix the problem, okay? And of course they know exactly what they need to do in order to do it, but they're always too slow. They don't act quick enough, and they don't act with enough intensity. They should be printing the money into infinity and completely confetteize the currency. It's going to happen eventually. Might as well just get it over with. So this is what occurs every time around the increase. And what I notice is that there is this stagnation period of interest rates. Much less here in the 90s or late 80s in this case. It extends a little bit further here through the dot-coms. And now, just in the previous recession, we saw it going a little longer. And then they realized, oops, actually we're in a recession. Oh my God, we have to reduce interest rates. It all happens very, very fast. But what I wanted to notice after all my ranting is this. If I do this very, very crude line, which I'm pretty sure it's way off, but anyway, you get the point. They never get it to where it was before. So if I look at the Fed funds rate, there's no possible way, based on this chart, I'm not making any predictions, based on this chart, this is 3%, by the way. There's no way that it can get to 3%. It would be historically an anomaly, because we're seeing this. And actually, if I pull it back even further to where the 80s, you would see this again. It's actually keeps happening. Okay, the same thing keeps happening, keeps dropping. We've got a big problem on our hands, and I do not know how they're ever going to resolve. This is my number one indicator. Okay, if you want to know like what is this guy watching, I'm watching this right here. The fact that it cannot get back to that level again. Previously, it was at just over 5%. It peaked out. There's no way. It looks like 3% would be the top. Okay. Student loans as well have increased. I don't need to really harp on about that. The LIBOR rate, which some people don't realize, when you look at the LIBOR, something that a lot of people don't talk about, and it's not really mentioned on a day-to-day basis. So the average person doesn't get it. Those in the financial industry, a lot of them, in fact, don't really care about it. But there's $370 trillion of these so-called instruments that are using the LIBOR rate. So should the LIBOR increase, which it has been, we are going to see how that affects all of these financial instruments. We are relying solely on very, very low interest rates at this time. And if they're increasing, it's going to put a big damper on the economy based on the fact that companies are going to be slowing down. You're going to see that particularly in the financial industry. It's not good. Now, quickly going to Japan, looking at what they have done. There has been this stealth taper that has been present here for a little while. They haven't been talking about it, but it has been going on. The BOJ's bond buying program, which is obviously massive, we know that, but the amount at which they're buying has been slowly decreasing. It's interesting, very interesting, because this is one country that has been undergoing massive, absolutely massive levels of quantitative easing. The government bonds here, it's funny, it says Japan's government bonds, but I like to think of the J being junk, because government bonds are all junk. Anyway, looking at this here, you can see where this is headed. I mean, there has been, as far as I'm aware, 5 recessions in between this mega crash that they had and today, and it hasn't been this bad in the spread since that time frame. That's how serious it is. Despite the fact that they've been printing trillions of dollars worth of yen, it doesn't matter. You can't fix the problem by printing it over. You simply can't. It eventually catches up. If it takes decades, well, it eventually catches up. Japanese net foreign security holdings, look at the green line. That's US Treasuries. A lot of people don't realize what has happened here. They've been selling off. And it's not overnight. They've been doing so slowly but surely. And then the yellow line is foreign bonds excluding US Treasuries. That has been increasing. And the red line is foreign equity and investment funds. That's been increasing as well. So throughout that time frame, they've been making some changes. And I do believe it is very, very important to watch what central banks do, to watch what the governments do, see what they're buying, see what they're selling, and track the progress. That's what I bring to you here, but there's no possible way I can track it all. So you definitely need to look into this for yourself. I'm going to end the video there. If you found it informative, please give me a thumbs up. When you give me a thumbs up, it helps us support the channel. So I do appreciate that very much. And if you want the financial education that was not taught to you in schools, well, then these 2 books have it all. You can actually check them out. You can flip through them at Amazon. They have a look inside feature. And you'll be able to see that at the link in the description of this video. If you're more interested in the audiobook version, you can get that at themoneygps.com.